Well, hello, RCAF members. Thanks for being here in Deadwood today and for being part of RCAF. And also thanks for having me here with you today. First I want to start and say you've got a great leader with Bill Bullard. I've known him for several years, and I've had the pleasure of hearing him speak and seeing him working the halls of Congress. He's very effective. When I heard his presentation about what's happening in the U.S. lamb and mutton industry and what's going on in the cattle industry, I was shocked. I thought I was a well-informed consumer. I'm passionate about food. I enjoy cooking, and I strongly prefer American-made products. But I had no idea of the issues that you all have been facing. And sadly, the bigger problem is I think most Americans don't know your story either. And that's a real shame. In today's world, more and more consumers are taking such an interest in where and how their food gets to them. And so what's happening to you all, it just shouldn't be happening in this type of a world. And I've heard Bill say, research shows that consumers strongly favor American beef and they're willing to pay a premium for it. But consumers don't know about the WTO ruling that happened. They don't know about Cool. And they don't realize that that product of the USA stamp on their beef, it's become what I consider to be a fraud. They don't realize these other issues that you've learned about, currency and subsidies and all these things. These all add up to why they only see lamb from New Zealand on their shelves today in markets like Chicago and New York and Washington, D.C. So, of course, once you learn the truth, it's pretty clear that the U.S. cattle producer industry, it's being repressed by the same forces behind the 2+ decades long, this insane push for globalization in this world. These multinational corporations and their Wall Street financiers. Many, they've now combined into what have become essentially monopolies and oligopolies. And all of this, it's eroded profits and it's damaged the real American producers. Those who really create wealth in your industry and in industries like mine. But Bill and the RCAF team, they're just doing a great job out there pushing back against this Goliath. And you've certainly opened my eyes, and now I hope to be an advocate for your cause as well. But the more I thought about it and the more I learned about it, I realized that once I saw the bigger picture, your cause and my cause, they're the same. The common cause that we're out here fighting for, it's called trade reform. The blatant destruction of America's once vibrant production capacity in so many sectors, it's become the single biggest threat to our national security and our way of life. Because of the public policies focused on finance instead of production, more and more the United States, we can't produce or maintain vital systems, products, and the good jobs upon which our economy, our military, and our people rely. We must take a step back from the failed policies of the past 20 to 30 years, and we've got to do something different for all of our industries, for all of America. So in preparing my presentation today, I took some time to read your latest newsletter, and I checked out your RCAF website, which is pretty slick. It's good stuff in there. I realized that besides sharing a common cause, American ranchers and small to mid-sized manufacturers like me, we actually have quite a bit in common. For example, many of us, we're family businesses with multi-generational involvement, just like mine. And I can see that you value your team. You value their skills, just like we do in manufacturing. And I also suspect that many of you, like me, you feel that producing something of value, something tangible, making it, mining it, or growing it, it's doing the kind of work that's meaningful in a way that is more than just about profit. There's a greater purpose. So for me, it feels good to work hard with a passion and dedication to make something that's tangible and creates value. But lately, it's been a tough road for many of us. Just like in manufacturing, I know that there's folks in your industry, even those who are the best of the best, you've struggled to make a profit. And that's why we share this common cause, this trade reform. So please let me tell you a little bit more about myself, my company, and my industry. You'll hear how my small family-owned manufacturing company was a bellwether for the problems caused by globalization. And then I'll wrap up with some information on the current trade reforms and where I think we're headed here. Again, I'm Zach Mottl, and I'm proud to be the 4th generation of my family to own and operate our company, Atlas Tool Works. My great-grandfather founded us in 1918 101 years ago in Chicago. We started out making tools and jigs, dies and fixtures for the booming industrial economy around Chicagoland. And of course, Atlas, we've changed, we've evolved over the years. And we stayed on the cutting edge, investing in new manufacturing technology, new trained employees, and today we've morphed into a precision component manufacturer. In our primary markets, they're aerospace and defense, medical, industrial equipment, but we also do some work in the electronics, telecom. We even still make a few consumer products, coat racks and coat hooks. There's probably some of them in this building. But we're well diversified. It wasn't always that way. For the first 80 years of our experience, we were heavily reliant on the telecom industry. Atlas had been a manufacturing supplier to Western Electric. Then its successor became AT&T with Bell Labs, and that turned into Lucent Technologies. We were in the telecom industry since the early 1900s all the way into the early 2000s. Western Electric was my great-grandfather's first account, and it served Atlas well for over 80 years. But besides great jobs and advances in communications, there's so much more that the American telecom industry gave to us. The radar system was invented there. The transistor came out of Bell Labs, and the laser too. All these high-tech inventions, they've got both commercial as well as military applications, and they were funded out of the research paid for with American tax dollars, with your money and mine, and with profits from the telecom innovations and the telecom networks in our country. But there was a lot more than just these sexy high-tech inventions that came out of this telecom sector. There was a huge domestic manufacturing sector. My company was a part of it, and so many others were. And we could make the equipment, we could develop it here, and we had so much innovation and advancement out of that basic manufacturing. But by the year 1999, over 85% of my company's revenue was from telecom. You know, we didn't need anything else, or so we thought. You know, we had profits, we had growth, we had stability until about 24 years ago, right when China was granted most favored nation status and joined the WTO. Right around the year 2000, we saw a mass exodus of the telecom equipment industry out of America. This high-tech, high-innovation industry, it went to China so fast it was stunning. Most people don't realize how many manufacturing jobs in the USA fed into that industry. And its loss took work out of every shop in the USA, and for mine it was particularly hard because we were so devoted to telecom. But fortunately, we were able to pivot at Atlas. We reinvented ourselves, and it was a little painful. We found some new industries, we found some new customers, and over the next few years, but so many of my peers in manufacturing, they didn't make it. I would come to meetings like this and they'd tell me about what was happening to them. They're not here anymore to tell their stories. But where we can see their stories, it's in black and white. It's in the numbers, the terrible loss of so many manufacturing jobs over the last decades. And that impacts more than just manufacturing, all the industries, the multiplier effect of manufacturing that feeds into it, right down to what people can afford to pay for the food at the store. So it didn't have to happen this way, though. America, we led the world in producing telecommunications equipment. We invented it. The American telecom industry was a crown jewel of American manufacturing. There's a gentleman named Matt Stoller and Lucas Kuntz. They recently interviewed me. They wrote an article titled, "America's Monopoly Crisis Hits the Military," and it was published in the American Conservative last month. I think their piece really eloquently captured what happened, and I'm going to share some of it with you. Matt and Lucas wrote that it wasn't our strategic adversaries that killed America's telecom industry, it was Wall Street. And its pressure on executives to make decisions designed to impress financial markets rather than the long-term health of our companies. In 1996, when AT&T spun off Bell Labs into a telecom equipment company, Lucent, there was this desire to take advantage of investors' appetite for an independent player selling high-tech telecom gear when Congress deregulated the industry. And at that time, Lucent was the biggest IPO in history, and they were my biggest customer. Most Americans ended up with stock in their portfolio. Probably many of you had money out of it, and probably many of you lost money on it in the end. It became the biggest IPO and the foundation of a relationship with financial markets that led to the company's eventual collapse. Matt and Lucas continued in their story to say that the focus on the stock price at Lucent was systemic. The stock price was posted daily. It encouraged everybody to focus on it. And the company's relationship with short-term financial-oriented markets, all the employees got a number of founders grant option shares, and the executives got even bigger slugs of shares to make sure that connection was locked in. Their CEO, Richard McGinnis, in 1997, he focused like a laser beam on those financial markets, and Lucent began to buy up companies. They perceived the need to compete for acquisitions and became a strategic justification for keeping that stock price so high. And that changed and in turn demanded meeting or exceeding these crazy quarterly revenue and earnings targets ever more and ever more, objectives that the Lucent top executives became obsessed with. Meanwhile, they forgot about what made them a great company in the first place: the manufacturing, the research, the development, the telecom equipment. And along the way, they started to get more aggressive. McGinn had a subordinate, an executive named Carly Fiorina. Many of you have heard of her. She juiced the returns with a strategy based on lending money to risky startups. And those startups would turn around and they'd use that money that they got lent and they'd buy equipment from Lucent. So she collected $65 million in compensation, and the stock soared. And then, a few years later, the dot-com boom turned to bust, and that company, full of accounting scandals that were simply designed to impress the shareholders, rigged the stock and the financial markets, it began massive layoffs. McGinn, the CEO, he got laid off too, but you know what? He left with $12.5 million severance package. To me, that's pretty royal compensation for taking one of America's strategic industrial assets down the road to total destruction. And meanwhile, my little company, Atlas, we lost several $1 million over the next few years, and we struggled to get back to break even. You know, we're just one of thousands of longtime telecom vendors who were all the victims of this finance-centric global agenda, and I don't think any of us knew it yet. By the mid-2000s, a little before 2005, I started to see some hope, and the telecom equipment market began to recover from the recession. We saw demand picking up, and there was even an exciting new opportunity that they promised we were going to make telecom equipment and ship it to China and build out their phone networks. That was all the buzz in our industry. But little did we know, Lucent's new strategy was to seek margin by offshoring production to China, continuing the layoffs of American workers and suppliers and hiring abroad. At first, it was just the simpler parts of the telecom equipment, boxes, a little assembly work here and there, maybe some little resistors. But soon, contract manufacturers in China, they were making all of it. And combine that with the fact, I don't think even Lucent or its peer competitors knew at the time, the fact that China never really had any intention of buying a lot of equipment from foreign companies. The promise of big telecom deals in China for American and European companies, it was nothing but a bait and switch. Unfortunately, this offshoring move and finance-centric approach was terribly short-sighted strategy, and Lucent never recovered. Now we've got these Chinese companies that you've heard of, Huawei and ZTE. Those companies came out of nowhere, subsidized by the Chinese state and using stolen Western technology. They underpriced the Western companies. American policymakers, our lawmen and women, asleep at the wheel, unconcerned with industrial capacity. You know, back then I would go around in DC like Bill does today, and I would talk to legislators, congressmen, women, and tell them my story, tell them, what are you going to do about this? This is a tragedy. I can't tell you how many legislators told me, oh, don't worry, Zach, we're all going to move up the ladder a few rungs. No one wants to do that kind of dull and dirty and boring manufacturing work anymore. We're going to be innovators. We're going to do high tech. I said, but wait a second, you're giving away high tech right here. They didn't care. They stood by foolishly, and they let these Chinese companies capture market share with predatory subsidies and stolen technology. And by 2006, a French telecom company named Alcatel, they were struggling themselves, but they saw a merger with Lucent to maybe bring these two together and get some strength against the Chinese, so they bought Lucent. And then a few years later, Nokia, they're still around, but they're still struggling. They bought Alcatel. So I don't know how all these bad companies added together is going to make a better one, but that's what they kept trying because they didn't know how to compete against the Chinese. And that was the end, that last deal, the end of American control of a technology powerhouse called Bell Labs. That was a huge nail in the coffin for American innovation. And today, Huawei, with state backing, they dominate the market. And Bell Labs, along with its game-changing innovations like the laser and the radar system and all those things, what we don't even know is going to be invented in the future, it's gone. So the erosion of the rest of the American producer base, people like you, those who make it, mine it, or grow it, went down pretty much the same way my example of Lucent did. Wall Street financiers focused on short-term profits, market power, and executive payouts over core competencies like research, production, innovation. A lot of times these Wall Street types, they'd roll an industry up into a monopoly producer. And I know you've seen the same thing with your meat packers. We just heard it earlier in your industry. And then what do they do next? They offshore the production to the lowest cost producer. So it's a finance-centric approach, and it opened the door to the Chinese government's ability to strategically pick off industrial capacity by subsidizing its producers. Just hand over the cash to Wall Street, and China can get the American crown jewels. Losing all this production and manufacturing capacity, it's had a devastating effect on our research capacity. I like to say, innovation doesn't just hover above the Great Plains here. You know, they think we're all going to be innovators like those congressmen told me. No, it's built on steady, incremental changes and the knowledge you learn out of basic manufacturing. So in my example, that telecom equipment, it's also dual use. We hear this when we're talking about Huawei and spying and stuff. It can be used for both commercial and military purposes. And the loss of an industrial base and telecom equipment, it means that American national security and our military lost capacity when we gave up all that to China. You know, in historical terms, this is a pretty shocking turnaround, pretty fast. Americans, like I said, invented the telephone, the internet, and until recently we dominated it. But in 20 years, after 80 years of growth, 20 years, every single American producer is gone, and we've only got Ericsson and Nokia who are struggling, and Huawei and ZTE in China. So now I'm fortunate, my company, we pivoted after that pain. We found the aerospace industry. But I think to myself, and I worry about this at night, I think about, you know, how are my new airplane customers, how are they going to deal with, there's new Chinese jets that are flying. They're flying and testing their first single-aisle jet. And so when profits don't matter for companies like that because they're government subsidized, how can we compete? What industry will Atlas have to pivot for? What industry will my peers have to pivot for over the next 100 years if we keep letting countries undermine the capitalism model and take industry after industry and business after business? But I'll tell you, there is some light at the end of this tunnel. And that brings me to what's happening with the current trade reforms and where we're headed. There's a lot of us, most of you in this room, with an eye toward righting these wrongs, and most of us agree on a few things. The first, free trade, it's a unicorn. It doesn't exist, and the policies that have attempted to support free trade, they've been bad for the majority of America. Also, we agree that persistent, excessive, and ever-growing trade deficits are bad for America. And finally, we believe that the dollar is overvalued and it's harming true wealth-generating industries, the ones that make it, mine it, or grow it in the U.S. So these policies of the last few decades that favored capital over labor, they've driven unsustainable global imbalances, our trade deficit. Now we need the pendulum to swing the other way. Because despite the rosy picture that many economists painted about the benefits of free trade, the fact is that the numbers show it's not worked that way. And if you look in history, no country in the history of the world went from poor to rich with free trade, and that includes the USA. Go back to Alexander Hamilton. We haven't had a plan since 1791, but we might need one again soon. Conversely, countries who run these persistent trade deficits, they're going to go from rich to poor. That's what happens. And we've seen in recent decades how wealth has become so concentrated at the top here in this country, and the pain and the wage stagnation, everyday people, manufacturers, ranchers, farmers, and laborers, we've been feeling all this. That's what the Trump administration understood. And that's why they're taking these actions. Simply put, that pain is because we in this country, we're eating global oversupply among industrial nations. In order to heal the damage that this free trade has caused, we can no longer be the consumer to the world. Our trade deficit, it destroys good jobs. It's sucking the wealth out of the middle class of our country. And we can see all the social ills that come with it. There's deaths of despair. Farmers, the most productive in the world, are committing suicide. There's an opioid crisis. It's fueled by the lack of good prospects for so many of these people. They're working their tail off and they can't get ahead. So U.S. trade action will and should continue until we figure out how to quit the job as the world's consumer of last resort. And now, thank goodness, we've got a trade reform hero with President Trump. Clearly, he saw the issues, and whether folks like everything about him or not, I'm pleased he's been the first president in decades to have the strength and the will to stand up to the financiers, the globalists, the multinationals. He's the first one in a long time to do something about these Main Street problems. So what is it that he's doing? Let's start with trade agreements. I know you're probably pretty well educated on these ones here. He said that he'd toss out NAFTA and replace it, and it looks like he's going to deliver on that. And then we're moving on with USMCA, and I know that unfortunately COOL has not made it into the agreement. That's a big problem. It must be remedied in one way or another. But the reality is, USMCA, even for its faults, it moves the needle in a positive direction for trade reform. I have friends in the labor movement. They're pleased with the opportunity to raise wages in Mexico because they get it, that at around $19 a day in Mexico, American labor will have a very hard time competing against the adjacent Mexican counterpart. But just as importantly, with wages that low, Mexicans can't afford to buy the products that they're making. They're just shipping the Fords here. They're not buying any of those cars. So remember, in the U.S., if we want to stop eating the global overcapacity, and we need these other countries to start consuming their production and not counting us to be the consumer of last resort, raising wages in Mexico and other places will help with that. So labor, they're also happy with some of the new cross-border trucking rules. And my friends in the automotive supply chain, I don't do a lot of automotive work, but I've got a lot of peers in Chicago that do. And they're pleased with some of the automotive supply chain changes in the USMCA. They see an opportunity for a lot of components in the supply chain to come back here. And that'll mean good jobs for those displaced folks around America. And getting some of those automotive jobs back, I think, will help with that. So that's a positive of the USMCA. I do believe that ultimately it'll pass. And I hope there's some way that COOL gets in there. And I know that Bill and all of you are working. And I'm talking to the Illinois delegation about it, too. I don't know if they're hearing it. But there's an opportunity here. And I think it's good to show momentum, to show progress, and to get a win under the administration's belt, to show the world that we're serious about making these changes. But for me, and I hope all of you will hear this, trade agreements, they're a big sideshow in this circus. Don't get me wrong, right? They're important, and they can help or harm industries just like you all see with COOL, but for me, they're not the main event. Trade agreements, what they do is they change our balance of trade, what we trade with who. They can move the needle in specific sectors, but they don't fundamentally make us more or less competitive in terms of the forces that are driving these persistent trade deficits and global imbalances. So what's next? Well, the administration's got these moves here with tariffs. And despite all the hype and the hair on fire comments we hear from these multinationals in the media, I don't think tariffs are the main event either. They're another important tool in our tool belt for managing trade, but they're also a sideshow. And what they do is they affect the balance of trade, just like trade agreements. So early on in the administration's moves on the tariffs, I came out vocally in support of them because I do believe they're an important tool. That put me out of sync with a lot of economists, which is fine because I'm not one of them. And some of my brainwashed globalist manufacturing peers, they got pretty mad at me. They forecast these dire results from the tariffs. But keep in mind, there's an old saying about economists. They don't make forecasts because they're good at it. They make forecasts because they get paid a lot of money to do it. And so what we've seen, what my peers in manufacturing have seen now, after these tariffs have been around for a little while, is just the opposite. They're doing what they're supposed to. They're stimulating domestic demand in specific industries, and they're changing the balance of trade to support strategic industries that we want to have here, like the solar tariffs, like the steel and aluminum tariffs. Those have resulted in new capacity and more jobs. Same for the tariffs on washing machines and on so many other manufactured goods that are coming down the pipeline. And really, we've not seen price increases that those economists predicted because the tariffs are largely being absorbed by foreign producers, distributors, and OEMs. And because of currency manipulation of our trading partners, as we saw with China the other day, they lower their currency to offset the tariffs. So personally, my company, we've seen a significant increase in demand over the past year. We just closed our fiscal year in July 31st is our fiscal year end. We were up 23% on our top line sales this year. Our industry is getting busy again and demand is coming back. And with demand, that means pricing power and all the good things that come with it, like profits and wage growth. Our profits grew by a whopping 400% last year, and our wages, because of those profits, they're up 3% this year. Not even counting quarterly bonuses and profit sharing. That's going to add another 2 to 5% to my team's paychecks. So it's not just my company, though. I'm also involved in my industry association in Chicago. It's called the Technology and Manufacturing Association, or the TMA. We've got a Midwest Manufacturers Outlook. It's a monthly survey taken at 1,000 member companies like mine to track the opinions. And overall, the members, they're pretty positive about the U.S. economy right now. I know there's been some talk about the recession, but we're not seeing it yet anyway. Our recent data showed that 65% of small to mid-sized manufacturers, we anticipate growth in sales over the next 12 months. That's really good for the economy as a whole. 41% of our members anticipated increased capital spending in the next year, and 59% anticipate increased employment over the same time period. Of those 1,000 member companies, we employ about 30,000 people in Chicago. We're a pretty good barometer. Last month's survey, the vast majority of TMA members actually favored the tariffs, almost 60%. And most TMA companies are like mine, supply chain companies. We make products for other larger companies, so we're part of this global supply chain that you hear about. So while the TMA members were initially frustrated by the higher steel and aluminum costs, most of us saw it as short-term pain in support of the larger issue of reshoring the entire supply chain to the USA. And so much of the optimism that TMA members exhibited, just like my company, it's being driven by the improved demand picture. We're busy again and our order books are full, the profits are returning. Now, the primary pain point that I hear for people in my neighborhood is the lack of skilled workers, which has held more than a 2-to-1 lead over the 7 other pain points in our survey for most of 2018 and all of 2019. So while our data showed that an increase in material costs at the beginning of those steel and aluminum tariffs, it was kind of a major pain point last year, nearly all of that has gone away. I think there was a lot of noise in the metals market. There were some shortages and people were taking advantage of these tariffs and jacking prices up and stuff. That noise, it's gone away. And also more capacity came online in the U.S. You've heard of the steel and aluminum mills adding capacity. So most of the raw material prices, things that we buy, I just placed a bunch of orders before I came out here. I'm seeing prices back down to before where the tariffs were at. So if trade agreements and tariffs, if they're just important tools, but they're not the big stick, what is it that can really help solve these global trade imbalances and restore our fine country to balance? I believe, and so do more and more people, that it starts and ends with currency, with the bloated dollar. Americans have been spending more than they earned for 40 years. But you know what? It's not because Americans have been living it up. Average spending on consumption and investment grew at a stable rate from 1947 all the way through 2006. We're not ramping up spending, we're doing the same thing we have been. This happened not because of anything we've done, but because these people in the rest of the world, those oversupply countries, they've been living below their means. They've not been spending enough. These foreigners, they're consuming less, and they produce more, and they dump the excess in our market. And as I've basically said, they're sticking it to us with their surpluses. That's the root cause that I believe in. The resulting trade deficits, they've destroyed U.S. jobs, forced U.S. consumers to replace lost income with debt, and sadly, the measures that have been taken thus far, they've done pretty little to resolve the underlying problems. The U.S. trade deficit continues to widen, and while China's surplus has grown over the last year, thanks to declining demand for imports from the rest of the world, Barron's magazine, they argued last year, like me, Tariffs will not fix anything as long as China's elites remain committed to extracting as much as they can from Chinese workers. So China, like they did last week, they can lower the value of the yuan to make the exports less expensive for Americans and to further discourage imports to the rest of the world. And while China is not even the biggest or the only contributor of these global imbalances, in fact, Europe, they're currently a much greater under-consumer and over-producer than even China. They're a bigger drag on the global economy, and by extension, they're a bigger problem for U.S. jobs. But, you know, there is a solution. It's a very smart solution. It's out now, and it's a brand new bipartisan bill in Congress. It's called the Competitive Dollar for Jobs Act, or the Baldwin-Hawley bill, named after its co-sponsors from Wisconsin and Missouri. The proposal would require the Federal Reserve to keep America's current account, which is the difference between national income and national spending, balanced around zero over a 5-year period. And more specifically, the central bank, the Fed, would have to determine the level of the U.S. dollar, the level that's needed to balance income and spending. And after that, it would implement a charge to adjust the exchange rate. So that balancing level of the dollar, it would be lower than where it's at today, that trade balancing level of the dollar, perhaps as much as 20 to 25% lower. Joe Gagnon, one of the Fed's top economists, he's an expert, and he works at the nonpartisan Peterson Institute for International Economics. He recently said, the dollar tends to fluctuate between being too high and just right, but it's never been too low. And the reason is that foreign savers disproportionately prefer to store their wealth in the U.S. We're the best market in the world. We've got great liquidity, great legal protections for investors. So these excess savings from all these other countries from abroad, they've simultaneously financed our debt and caused the trade deficits by inflating the value of the dollar. And this persistent overvaluation, that's what's destroyed the U.S. jobs. That's what's forced Americans to borrow from abroad, and that's what's causing a lack of income. And now certain economists, remember I'm not one, I just play one on TV, certain of them, they've not come around to this reality. And they prefer to argue that exchange rates have little effect on trade patterns. But that's wrong. The data clearly shows a relationship between the change in the real value of the dollar and changes in America's current account balance. In general, a 10% move in the dollar translates to roughly a 1 percentage point change over time in the U.S. current account balance relative to gross domestic product. So right now, with the tools it has, the Fed, they can't simultaneously manage the value of the dollar, keep inflation under control, and stabilize the swings in the business cycle. And by the way, this is why the president keeps talking about interest rates, because when they go up, that just brings more and more of those foreign dollars and drives our dollar up higher. So the bill that I'm talking about, it provides the Fed with 2 additional tools to manage the exchange rate. The first, and what I think is the most important, is the market access charge, the MAC. It would require foreign savers to pay a tax each time they want to invest in the U.S. This charge would be applied only to new purchases of U.S. assets, and it wouldn't be a recurring fee on U.S. holdings. And the Fed, they'd have the discretion to determine what is the appropriate level of that charge to bring the dollar toward its correct level in a graceful manner. This is not a rapid change. We want it to come down gracefully. So the Fed, they do a great job with their mandate, and they manage the money supply with the country, but they just have no way to control those excessive capital inflows. And the MAC, you could describe it, it's a peak load charge on electricity. This happens when, at least in my area, sometimes when it's hot out, 100-degree day, everybody's got their air conditioner and everything going. You get a peak load charge, but they don't turn off the power. They let you keep using it, but they raise the price to help reduce demand. That's what the MAC would do. When demand is too high, it kicks in and gently brings the dollar back into a competitive and correct value. Now, some people say this is controversial. In other countries, though, they've used similar tools in the recent past to avoid unwanted inflows. And in fact, the IMF, the International Monetary Fund, they've endorsed what they call these capital flow management measures, that's a fancy name, as legitimate policy instruments, especially when the currency is overvalued. They did it in Australia, they did it in Brazil, they did it in South Korea. They've all imposed these taxes and certain restrictions on different kinds of foreign investment, bank loans, currency derivatives, and housing. And every one of those schemes received the IMF's approval. So the proposed market access charge that we're talking about, it's a much more simple and a much more comprehensive version, so I suspect it would also pass muster. However, it's not perfect. It would only deter profit-seeking investors like foreign pension funds and Asian insurers. These market access charge, it wouldn't discourage government agencies like the People's Bank of China from intervening in foreign exchange markets like they've done recently. So the bill gives the Fed a second tool, another tool. This tool is the authority to buy as many foreign assets as necessary to offset those unwanted flows, to neutralize the moves of those other central banks. And in theory, this could be a very powerful supplementary tool. So I don't know where I am on time, but we've covered a lot of ground, and I hope I've had your interest, and I want to wrap this up with a nice little bow. What would happen in a perfect world to fix all of the ills that Americans have suffered as a result of these decades of persistent and ever-growing trade deficits? What would be perfect is if those people in the rest of the world started consuming more, particularly in Europe and East Asia, if they'd spend more on themselves. They could buy more of what they produce, and they can export less. They could buy more from others and import more. That's their choice. Or they could do both. But at a time of low inflation and low interest rates and ample spare capacity, some economists do tell me, the ones I agree with and the ones that I think are the best, they tell me that any of those options would raise living standards globally, including in the US. So, you know, that's great, getting other people to do something. But it's been my life's experience that rather than trying to control the behavior of other people, I'm best to find a way to control my own actions to achieve my goals. And that's what I want to see for America. Trade agreements and tariffs, you know, they've got a role to play. But if we really want to solve this, Americans should be prepared to act unilaterally by deterring these unwanted capital inflows. It'll fix our trade deficits. It'll shift the power and income back to labor and producers like you and me. And so I just think simply we need this competitive dollar for Jobs Act, and we need it now. Based on what I've seen thus far, it appears to be gaining broad and bipartisan support. It's received some very positive reviews in the media and from both sides of the political spectrum. It's a bipartisan bill, and I hope for our sake, all of our sake in the country, that we get it passed this session. So that's what I see happening right now on global trade and these global imbalances. Thank you all for listening to me, and I welcome if you have any questions.